Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending February 3rd, 2017. What a week of fireworks we've had. And we've got a weekend of fireworks, or actually Sunday with the Super Bowl coming up for all of you US based or folks that follow the Super Bowl. We got a lot of international folks on that are in our group, and those of you also that are international that look at our free weekly updates as well, welcome. What I've got on the screen here is the daily chart of the S&P 500 futures. You can see on here, I've got a lot of things going on here, but we're close to hitting and taking out our all-time highs. Today was a really good strong up week. You can see that we've honored this uptrend here, this upsloping trend line. We've stayed right on it, and it's just been, you know, as we've been moving higher, I'm leaving this upsloping trend line on my screen here so that you can see that it's still a very valid line. We did have some bearish divergence fire off on this daily chart here, and that did cause some weakness in the markets, and you can see here we finally broke out of this wider trading range here, which was a consolidation range. The odds favored an upside breakout, but the bearish divergence just said that any breakout is going to be met by some softness in price, and that's what we got. We had a little bit of a move up, came back into this area again, and now we had another breakout today going into this weekend. Now, the momentum can carry us higher, of course, but I want to see that this momentum can hold us above the 2016 highs that were made towards the end of last year at 22.73. Now, the all-time highs are at 22.99.50. So let's see where we go. It seems to be following along the path that we've talked about, or I've specifically been talking about for quite some time. You can see the upward trajectory on the 200 EMA. You can see the upward trajectory on the 50 EMA. And I just wanted to remind you guys where we've come from, which was the, excuse me, the U.S. presidential election lows and overnight trading at 2028.50. We started taking longs in the futures market right in that area there. We had some contingent buy orders sitting out there, and they triggered, and we've been having fun ever since. Of course, that's not the only trades that we're doing, but we've been long the markets, and I know some of my friends and trading partners have been reluctantly playing the downside, expecting that next big move. Here it comes, and then anytime we have a downward shot, like right there, or like right here, or like here, or here, every time they come out of the floorboards and say, okay, now's the time, volatility starting to pick up, only be met by buying action, by buying action, by buying action, by buying action, just over and over and over again. Now, at some point, they're going to be right? We're going to go down, we're going to come up, and it's going to peter out, and we're going to go down further. We're going to come up, it's going to peter out, and then we're going to start a channel to the downside. But we're not ready yet for that. There are a lot of TV talking heads trying to say, here's why the markets are going up. But at the end of the day, as you guys know from my webinars, the free ones that you see this weekend, or at least from the members that are in our group, you certainly know I could care less what folks say on TV. In fact, you could put it on mute. We follow where the price action wants to go, and we look at the charts and they tell us what we need to do, because everything is typically priced into the price. I mean, it is what the market is saying it wants to do, regardless of your emotional or logical area where you think the market should be. But if you follow the actual price, that's where the markets have decided they want to be at this point in time. Okay. Now, if I take everything off the screen, you can see here just those indicators that I had talked about, or those tight spots that we've been in, right? And then we've broken out once. We came back inside here, and then we broke out again. So now the question is, we're going to take out 2,300. I think so. It's to me, it seems like a layup. And we may go a little bit higher, 23.20, 23.25. I do believe it's going to set up for some more weakness, and we may come back and test this area again. I do believe we're going to come back and test this area again too. But I'm not going to be like some of my buddies and try and tell you when. But I do believe that that 2200 area there is just like a bug zapper, just, calling out to the markets. We still have some momentum that's sitting on the sidelines. That could drive it a little bit higher, but that's kind of where I believe we're going. And if we look at the volume, all right, let's come over here and take a look at a volume for a minute. Now, one of the things I show on my volume that you may not be able to do in your charts, but if you can do it, it's a great thing to do. I've got, I use a 5 and a 20 EMA crossover on volume, right? Rather than just having a simple moving average or an exponential moving average of, say, 20 or 50 days, I do a crossover, much like I do on the charts up here. And then what I do is I follow this, and you can see that in this move that we've had up like this, you can see the 5 has spent most of the time above the 20. Really, and so the volume has come up. We've had a couple of spikes here, but the volume is coming up off the holidays, and it's been basically moving in an upward direction. I like to see that, right? Now, towards the middle of December, towards the end, you can see right in that area there that I'm circling going into the end of 2016. You remember the 2 weeks where we pulled back? Look at the volume. It just fell off the table. So that just told me that this volume or this pullback here was really nothing to worry about at this point in time. I do believe the breadth of the market is getting thinner and thinner, meaning this up move here is supported by a less percent of stocks that are over their 50 EMA than under their 50 EMA. In other words, there's more stocks under the 50 EMA as we go higher and higher. So I need to see some more breadth in this to see if we can have some more push through or follow through in this. But you can also see that going back to the night of the election and going forward on another indicator that I use is the RSI, but I use the 50 level of the RSI to give us a sense of, where in the daily range of trading is the market's closing, and we're over the 50% level right now. So we are, and every time we come back and touch this, we're bouncing back up again. So this does tell me that our decision early back in here to get more along the market has paid out very well for us, and now we're just sitting right up at this level here. I do believe we're going to start to run out of some energy. If we look at the weekly chart here, let's just step it out. Take a look at it a little bit of a longer time frame here, and let's get everything off the screen and kind of clean it up for you. First, we'll look at the MACD. You will see there is absolutely no bearish divergence in this. This is a solid move off the election lows here. You can see, well, that's not a very straight line, but that right there is no bearish divergence from that pivot high to that pivot high here. That means any pullback here is probably going to more than likely be bought, all right? So I've been using these pullbacks as a way to adjust trades or add to trades or put new trades on, all right? And that's kind of what we want to do. So that tells me that the momentum here can move a little bit higher. Now we are in an overall Elliott Wave 3-4-5 pattern. And then typically after an Elliott Wave 3-4-5, because you could see the 3-leg, the 4-leg, and then the 5-leg here. 4-leg is a profit-taking leg, and then you got a 5-leg. But you've got these jagged moves here. But we are still in this wider channel. I didn't draw it very straight, but you can see we're up in the upper bounds of this channel. So again, a little bit of a pullback would make sense to me, and then it would probably settle in, and then we would resume the highs again. Although Friday we had a lot of momentum going into the market, so I think that will probably continue early in the next week, unless we get some kind of existential threat that right now the markets are not prepared for. So that is the E-mini S&P 500 future. So you can see here that we're moving up into this area. Now, if we look at the NASDAQ is still doing very strong. It's still leading the pack. It was up 27 points today. And we're challenging the all-time highs on the NASDAQ future 100s at 51.68, right? This green dashed line here is the dot-com bubble high. So again, on the NASDAQ, we don't have on a daily chart any divergences to speak of. On the E-minis, we do, but because of the NASDAQ, we don't. That leads me to believe that a lot of money is flowing out of some of the other indexes back into the like out of the E-minis into the NASDAQ and into a few of these others here. Even the Amazon crater after their earnings was not enough to put the markets in a downward move, right? And if we also look at the Russell's been strong lately, and in fact, the Russell came down here, as I pointed out here before, and it's just been the 50 EMA has been holding it up. And if you guys remember over the past couple of weeks in watching our updates, I said that if the rut breaks the 50 EMA, that's going to send a negative signal everywhere else. So you can see that the 2017 high is actually lower than the 2016 high. But we've got this pattern here that looks kind of like this, which is really a bull flag pattern, which suggests a breakout to the upside and then an extension higher, and we'll make new all-time highs, at least in the near term. That'll probably set us up somewhere in this area up here for a rollover, which would then give us another bearish divergence and would probably come back and test these levels again. But near term, I would see us moving a little bit higher here. And you can see, again, just like the others, off the election lows, we actually were in the red on the Russell. We were in the red on almost all indexes on the election night, November 8th, and then the 2016 made its shear in the last 6 weeks of the year, or the 6 weeks after the election. And then the 2 weeks going into the end of the year, it kind of pulled back a little bit. But the entire year for 2016 was made in 6 weeks. Now, looking at this here, though, pay attention to the 50 EMA. If this thing breaks, you're going to probably see more money come out of the Russell, and you'll probably see money start to drift out of the Dow and out of the E-minis as well. And then if the NASDAQ breaks, and that's the big one, because that's the one that's kind of pulling everybody else up. If we look at the Dow futures, you can see the Dow futures are approaching its 2017 highs of 20,073. Okay, so the important thing about the Dow futures is the futures anyway, we didn't hit 20,000. The Dow futures closed Friday at 19,994. The cash index well over 20,000. In fact, with the cash index, we closed at 20,071. So we've got this, but I will caution every one of you, both the Dow, the E-minis, especially the Dow and the E-minis, are showing signs of just running out of exhaustion right up here. And unless we get more breadth of market going forward, we're going to stall out here. So even though Friday was a really great day for the bulls, just kind of keep that in mind. The other thing I'm going to show here is volatility is still extremely low. Now we got volatility futures expiring in a week or so. But if we look at the VIX, it closed at 1097. And you can see the low of the VIX for 2017 was made on February the 1st at 997. I mean, folks, this is extremely low volatility, very low. And of course, the risk of a vol move down at this area is not to the downside, it's to the upside. And you're going to get these spikes. So this tells me the market has just kind of got that Alfred E. Newman look of what? Me worry? And you can't have that. So let's be very careful down here, which means if you're a credit spread trader, I've got these color zones on my VIX chart for a reason. They work out very well. It's just different strategies we deploy, our members deploy based on what zone we're in the VIX, right? And the black swan, of course, is up. The VIX is over 50. And it just kind of shows the strategies that we want to deploy. So you can see where we're sitting right now. Now, we can stay down here in the green for a month or 2 or 3 months at a time. Very easy with little bitty spikes moving back up. But understand that the risk of a move up is greater every day that we stay down at this level. So just put that in the back of your mind there and just don't go all in here. If you've missed a lot of this bull run, don't load the boat right now. Just be a little bit cautious. If we look at the bond market, now the bond market was relatively flat today. It was up a little bit after the jobs numbers. The job numbers came in actually quite strong. The only thing that was weak out of the entire report was that the wages came in a little bit under. There was wage growth, but not the percent that everybody wants to see. That's kind of what the Feds are focusing on too. They want to see a lot of wage growth. Unemployment ticked up just a little bit only because there's more people out in the market. But one of the Chicago Fed president came out and said we should keep our rates lower for longer to give the economy a chance to gain its footing. And, you know, after he said that, the markets continued their bullish way, and that just added to the wind and the sails, you know, of the bullish sailboat moving, cutting across the water. You can see in the bonds, I'm still calling, I've got this 3, 4, 5 pattern. That's a classic Elliott Wave pattern, right? I mean, it's classic. And I've been talking about this for the past few weeks. The timing of this bar here is put on by my charting system. I could do it manually, but it just takes more work. These bars define the timing of the move, and the length right here defines, or the length and the location defines the price, right? So it's saying sometime in the middle to end of February, possibly the bonds could end up down here. That would give us an Elliott Wave 5 at the bottom down here, and then from there we typically go into an ABC pattern. We're going to start to bottom a little bit in bonds now if the Feds maintain their dovish policy, which there's no reason to believe they won't. But I do believe we're going to have some surprise moves to the upside, all right? But overall, I'm still neutral to bearish in the bond market. And then, of course, if we look at the currencies, it's really interesting today. If we look at the U.S. dollar, it had a really interesting move on the jobs report. The dollar is down. Now, you would logically say, hey, if the economy is getting stronger, won't that put more pressure on Aunt B, aka Janet Yellen, to come out and start to tighten interest rates? Yet we got the Fed governors coming out and saying, au contraire, we're going to keep it low. We want the economy to run hot. So that tends to create a little bit of confusion in the market. Now, we've had this long downward trek in the dollar, which really started back in January. In fact, the first day of January. So all of this is the 2017 year for the dollar. We entered up here and we're down here. It has been that channel that we've been in for the dollar, okay? And that is superimposed on this channel that we've been in to the upside of the dollar. So in a larger scheme of things, this is an up move. This is some profit taking, a little bit of consolidation, I suspect, and then we're going to move higher. This move higher is going to be when the Fed start getting more serious about raising rates, put us back up into an area that's kind of my target, up in this area here, and then we're going to start a bigger move to the downside in the dollar. But this is kind of, right now you can see this wide bar up here. I'm calling for the markets to move up here sometime in March or April. And in fact, you could see it. I did it on a weekly chart just to really take it out. You know, it's calling anywhere from the beginning of March all the way into the middle of summer, into the August time frame. So we're not done yet with this downward move. In fact, you could see if I put it on here and put it here, you can see the correlation of this regression channel is 0.92. The tighter the pattern, the higher the number. 0.92, guys, is very, very high. It's just a very controlled sell-off in the U.S. dollar, okay? This will end. We're coming up on a key 200 EMA. I'm looking for that to hold at this point in time, but we'll see. I've been playing the dollar down and the euro up, because if we look at the euro, you'll see here, obviously with the dollar down, the euro is going to be going up. The euro looks just the opposite. The euro is a little bit more volatile. If I were to draw the pattern here, you can see the movement here in this one is a little bit wider, right? But this is the channel we're coming in here. And then on the euro, it's just the opposite. We're looking at a movement up here like this, giving us a 3, 4 pattern, and then a possible move back down here for a 5 when the Feds come out and start getting serious. And then we're going to get into an ABC chop, and then I think the euro is going to take back off again. So this is kind of my short-term if you will, direction of the euro. and the dollar. Now the British pound, relatively flat today, but I am more of a long player in the pound than a short player. I think any pullback here should be bought. I think the pound is going to move much, much higher. I think the British economy is going to be stronger than people think. I think the Brexit is more about emotion than anything else, but I do believe if we can break out above this key level right here, the 12806, then it's off to the races. We got a 200 EMA to challenge at 130 to the dollar, but I do believe that, I'm going to be watching this right here. If it breaks down a little bit, I'll watch it, but down in this area here, I can tell you right now, I'm going to be a buyer of the pound instead of a seller. That's just kind of how I'm looking at this right now. If we come over and we look at metals and gold, I think longer term gold is going to be up. It cannot get above its 200 EMA right now. I've told our members the 200 EMA is an important number. It's an important technical milestone for gold. You can see over here on the left-hand side of the screen, it held up for a day, and then when we finally broke it, all hell broke loose and it just came down. Now you can see in this area here, it's just not able to get up above it. Intraday, yes, but on a daily basis, we've just stayed right below that thing. You can see the 200 EMA has almost got a flat level vector. The 50 EMA has got just a very slight upward cant to it, which is kind of reminiscent of this move right here. And if we come in and we look at volume on this, just to see if gold futures are climbing on volume, and it is, right? I mean, if you look at this, it's very clear that, as we've started this move off the lows here going up, look at the 5 over the 20. I mean, that's clearly going up. And then when we had this pullback right here, volume came back down. In fact, the 5 broke below the 50 EMA, and then the minute we started that run up from here, we've come back up again. So volume is supporting the direction of the market, which is what we want to see, especially in gold. Gold is one of those indicators that trades very technically, or let's say very well technically. So this is kind of where we're sitting with gold. For our members, we've already taken some trades in gold and gold miners, and you know what we're doing in those, and we may shut our gold futures trade down with profits on Monday and then look at another potential position a little bit later in the week. Oil, that's another one that we're profitable in. We may shut those down for nice profits on Monday. You can see here oil is in the no man's land. I think it's a fair price right here with oil. It's pretty much not going anywhere. I have said over and over again that I don't think oil is going to get back up over 65 or 70 anytime soon. I think the upper boundary here for 2017 is probably going to be in the upper 50s. The lower boundary is going to be in the lower 40s. I mean the upper 40s rather. So you're looking at about a 10 to 12 point range in oil, and that's kind of where I think we're going to be stuck. Remember, OPEC has got their production freeze, but it's going to end in May or June. Their view is it's going to cut out and pretty much load level the inventories. I don't think that's going to happen. The Trump administration is going to grant more drilling rights, give up more government land. You're going to see more rigs come online. We're going to start setting records here in the U.S. U.S. is going to start exporting light sweet oil, WTI, which has got a lower sulfur content, which is higher quality than Brent crude. And you're going to see that's going to push the prices down, and we're going to get back into another one of these kind of wars. But this time, the U.S. is going to be one of the drivers of the ship because of our fracking and shale and all that good stuff. So I think oil is going to have some great trades for us this year in the strategies that we're deploying. Corn. Well, guys, we've been bullish corn. You can see this upward sloping channel. And most rat brain traders end up trying to go long corn. They time it. They let it go up and then they get long at the wrong time. We're trying to time our longs, as soon as corn turns up. So we entered into a long position in corn right in that area there. You can see the 50 and the 200 EMA sitting on top of each other providing support. Should we break that level, we've also got some hedges using options in the futures market, a really creative trade that we're running. For those of you members, you know what we're doing. That's a key level for us in corn, but I believe the odds still favor to get back up into the center of the channel here and move higher. That would be the corn market. And if we look at the soybean market had a pretty rough down day also. It has broken out of the channel. It's kind of sitting on the 50 EMA. We've got to watch this very closely. If soybean breaks and starts to move lower, and then we get a break in wheat. Wheat is the only one that's not going up or going down. It's been in this tight box just like this for quite some time. The others have the channels going up. Wheat is going sideways. We're going into a seasonally slow time for wheat, so I would expect it to come back down in this area here. And then in this area down here, I'd be more interested to be a buyer in the wheat market. Softs, well, what can I say about OJ? It's the gift that keeps on giving. We've been short all the way down. You can see here that if I run a regression channel on this, just real quick, look at this, guys, 0.96. That is a tight channel. That means there's a ton of selling going on here. And we've been in this trade every time we get towards the top boundary above the center of the regression line, we look to take profits, and then when it starts to roll back over, we jump back in again, and we get these moves here. So I'm expecting this move to come back down to here, but I'm expecting orange juice to come back down in this area down here. So we've got some great trades in this. We've made a lot of money on the futures contract in OJ. You members, you know how we're having fun in this one. And then the other one that we've got here is sugar. Sugar had this move up. You can see here, again, the 50 EMA is playing a crucial role here in sugar. I mean, look at that. We're just sitting right on that 50 EMA. The 50 EMA is just running like this with a slight uptrend, and we spent 2 weeks there, over 3 weeks. And then look at it right here. When we finally broke above the 50 EMA, we had the run, came down and tested it. Every time we get up, we come down and test it. So I'd expect another run up to this level, a possible retest. If we break out here, then sugar's going to run a little bit more. You know, it's just going to run. And then I am going to add to my position, but only to the downside. I just don't see sugar staying up at this level very long. Now, it can go higher if I put it on a weekly chart. Let's just back it out a little bit. You can see here that sugar has been higher, right up to the 23 level or up to these levels up here. These are all-time highs for sugar, all-time highs. So can it go higher? Yes, it can. Clearly, we're still in a longer-term bullish mode here. And we're in this profit-taking mode and then a move higher kind of thing on a weekly chart. So in many respects, I'm fighting the trend a little bit. If we do bust a move back up in this area, I'll probably just wind my trade down and then wait for a better entry at a higher price because it's going to roll back over, right? But you can see this initial roll here, and it was a great trade to the downside. So that is the sugar market that we're looking at there. Now, the other one that I'm watching, it's not ready yet, is cocoa. Cocoa is hitting lows that we haven't seen. Let me just put it back on a weekly chart here, and you can see what I'm talking about here. Here's cocoa, and if we come back, we're sitting at a huge, huge support level, right around 2,000. And we haven't been back there since, 2012. And then can it go lower? Sure. We were down here around 673 back in the year 2000, right? I don't think it's going to get down at that level, but I do believe we're going to be challenging this level. If it breaks and starts to go lower, it's going to move quick because you can see the volume over price on this weekly chart. There's not a lot of dry powder here before it comes down. If we get down in this level down here, in fact, I kind of would like to see it get there. If it gets down in this level, we're going to be some happy buyers of cocoa. We're going to love chocolate. I don't see any divergences setting up here. In fact, I see more downside action. Any movement up is just going to be buy stops being triggered, and then it's going to roll back over. If anything, being short would be wiser than being long in cocoa. So we've got a lot of things that we're tracking here, guys, in our group. I've included in this update some membership offers for you guys, and we're knocking the ball out of the park again this year, kicking off the year. You might want to check us out. Otherwise, have a great weekend for those of you football fans out there. Have a lot of fun with the game. For our members, we got a session Sunday night. I'll try and keep it real short so that you guys can go back and enjoy the Super Bowl. But, after what? fireworks in Super Bowl, fireworks in the market. Money's money. Money never sleeps. Or as they said in that movie, Wall Street, money is a bitch that never sleeps. I like that. All right, everybody, have a great weekend, and I will talk to you guys later. Ciao.